Equity Market Update, November 2020. Equity markets registered strong gains in November 2020, with Nifty 50 gaining over 11% over the last month and ended the month near all-time high. The sharp growth was driven by uncertainty of US presidential election behind optimism around COVID-19 vaccines and sooner than expected administration of the same. Normalization of domestic economic activity supported by pent-up and festive demand and a better than expected 2Q FY21 results. The rally during the month was quite broad-based, and mid-caps and small caps outperformed large caps during the month. Most major sector indices ended the month in positive, with metals, banking, capital goods, power and auto registering double-digit growth. Globally, most major indices also delivered strong positive returns during the month. FPI flows have been strong in the current financial year, following the sharp outflows $8.3 billion witnessed during March 2020. During the month, FPIs bought equity worth $8.1 billion, highest ever net inflows in any month, as compared to net inflows of $2.7 billion in the previous month. Cumulative FPI inflows into equity increased to $21 billion in 8M FY21, as against net inflows of $6.6 billion in a similar period last year. Domestic equity-oriented mutual funds recorded net outflows of INR 18,262 crore in November 2020 compared to net outflows of INR 7,031 crore a month ago. In the first 8 months of FY21, net outflows from domestic equity-oriented mutual fund schemes was INR 35,830 crore as against net inflows of INR 34,019 crore during the same period last year. Q2 FY21 results were strong, with results of metals, IT, cement, financials, utilities and consumer staples being better than expectations. Results of pharma, oil and gas, telecom and industrials were largely in line with expectations. Outlook. As on 30th November 2020, Nifty 50 was trading near 26.9x FY21E and 20.7x FY22E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield continues to remain below its 10-year average. While Nifty 50 is higher than pre-COVID level, it should be kept in mind that these levels are not significantly higher than highs seen before the outbreak of COVID-19. Further, a significant proportion of recovery is attributable to select set of stocks, and broader market is still trading below long-term averages. Again, the corporate earnings in Q2 FY21, driven by cost reduction, has surprised on the upside and resulted in broad-based earnings upgrade. Hence, markets hold promise over the medium to long term in our opinion. Strong sequential improvement in economic activity, favorable external scenario, monetary and fiscal measures undertaken along with relatively better placed rural economy also supports this optimism. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, sharp rise in crude oil prices, higher than expected NPAs post the moratorium, escalation of border tension between India and China, and/or trade tension between US and China, significant policy changes post US elections, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.